Thanks, John. So we're FPX. I'm Martin Tren, President and CEO of the company. We're based here in Vancouver, and we're focused on the advancement of a PEA stage nickel deposit located here in central BC. A caution with the forward-looking statements. This is truly a Tier 1 asset in our view. That's a term that's used quite widely in this industry. We use three main criteria to define that. The first is scale. As the ore body is currently defined, it could support a rate of production of around 90 million pounds of nickel per annum, which would make this one of the 10 largest nickel mines in the world, and the resource body would support that rate of mining for in excess of 35 years. Secondly, and perhaps most importantly, is cost. Our current view of operating costs here is that we can produce nickel for around $3 per pound, which would place this in the bottom quartile of the cost curve. And thirdly, from a Tier 1 standpoint, we think BC is one of the premier mining jurisdictions in the world. The nickel market, as we enter 2020, is entering its fifth consecutive year of supply deficit. And you can see we're really in the middle of a long-term structural deficit that's driven by strong demand and sort of constrained supply. And so the question begs itself, who has the deposits that can be built in the next generation to serve the world's demand for nickel and square the market? This was a discovery that our team made in 2008, and in 2009 we optioned it to Cliffs Natural Resources, which at the time was a $10 billion US-based iron ore company. Cliffs came into this project before there was a drill hole put into it. It was a geological concept, and very quickly over the course of a few years they spent $22 million to drill off a very large deposit. So the latest 43-101 resource estimate we put out in 2018 shows that this resource contains over 6 billion pounds of nickel in situ, making it one of the largest in the world. Cliffs delivered a PEA to the market in 2013, and pretty shortly thereafter ran into serious financial difficulties, faced a bankruptcy risk. And so in late 2015, at the bottom of the market, we were able to buy the asset back from Cliffs for pennies on the dollar. Our project is called Descartes. It's located here in the heart of central British Columbia. The dotted line that runs just to the east of us is rail, so that's fundamental for low-cost shipment of this product, ultimately, in our view, to Asian customers. We point out here the Mount Milligan mine, which is located 80 kilometers east of us. This is a similar scale mine as what we envision here, a large open pit mine with a large concentrator. There's I think some view in the market that it is difficult at times to permit resource projects in BC. That's certainly been true of pipelines. The recent experience of the Blackwater project shows that BC is very much open for permitting of large-scale open pit mining projects. Blackwater is owned by New Gold. It's at the feasibility stage, and it just recently received its federal and provincial environmental assessment certificate. Giving you a bit of a satellite view of the project here. So we have a very large claims package. The claims package covers about 245 square kilometers. The main deposit at the project that's been thus far defined is called Baptiste, and I'll show you what that looks like now. So Baptiste sits here. That circle that I've drawn is about 2.5 square kilometers, just for perspective. Mineralization outcrops really across the entire deposit. The shape here is ideal for an open pit mine with a very low strip ratio. The strip ratio here is 0.17 to 1, so there's virtually no waste rock. And so low-cost mining is part of the key that unlocks the value towards making us potentially a very low-cost operation. You can see here these are logging roads and clear-cut areas. There is a lot of logging activity in this region. Allows us great access, and we're certainly not disturbing pristine wilderness with the advancement of this project. The ore body itself is enormous. It's a 2 billion ton ore body here. The coloration refers to the classification of the resource. The green here that you see is the indicated mineralization, so 85% of the resource is already in the indicated category, with 15% in the inferred, showed in blue here. So the geological risk has really been eliminated at this deposit. This is really, going forward, will be a function of engineering studies and economic studies to take the project forward, ultimately into permitting and into construction. So Baptiste is world-class in scale, contains over 6 billion pounds of nickel. We've defined another target, which we call the Van target. This target has recently become available to us for surface sampling of outcropping bedrock. We've taken samples at 50-meter intervals and defined mineralization over a lateral extent of about 3 square kilometers. So the lateral footprint here at the Van target is larger than the main deposit at Baptiste. The grades at surface are about 10 to 15% higher. This has never been drilled, and going forward, you can expect to see us put drill holes in here to see if we've got another multi-generational sort of world-class nickel deposit here at the project. The nickel at Baptiste and at the Descartes project is hosted in a mineral called awarenite. Those are the small reflective grains you see in the image of the core there. Those grains are a naturally occurring alloy of nickel and iron. And so this mineralization forms in a sulfur-starved environment. There's almost no sulfur here. The key property of awarenite is it's highly magnetic. There's a lot of nickel here. There's also a lot of magnetite. So those are two minerals that come along into the flow sheet. And what we do is a very simple two-stage process of magnetic separation followed by flotation to produce two very high-value products. The first is a nickel concentrate containing approximately 60 to 65% nickel. That would make this the highest grade nickel concentrate currently available in the market in the world. The magnetite in the deposit is concentrated into a separate payable product, which could add significant byproduct economics to the project here. When Cliffs was advancing this project, they utilized a different flow sheet, one that was based on magnetics and gravity. We have switched that flow sheet to magnetics and flotation. The table at the bottom of the screen shows the fundamental improvements that we see here. Cliffs in their 2013 PEA assumed we'd be producing a 13.5% nickel concentrate. We now see that concentrate will be significantly higher in nickel grade and can be achieved using higher recoveries using flotation. So this concentrate, as I mentioned, comes from host rock that is almost completely absent of sulfur, and as such, we produce a very clean product that can be suitable for direct feed to the stainless steel industry. Last week, we put out a news release announcing results of testing we'd done with Sherritt Technologies, which demonstrates that we can also produce nickel in a form that would be suitable for the electric vehicle battery market. So with this very long mine life ore body, the flexibility to produce nickel either for the stainless market or for the EV battery market would give whoever operates this project ultimately much more pricing power dealing with multiple markets and multiple customers. With respect to pricing power, Cliffs, in their view, in producing a 13.5% nickel concentrate for the previous PEA, assumed that our product would be similar to nickel sulfide concentrates. Now, sulfide concentrates, when they're sold to smelters, achieve quite low payables. They tend to get paid between 70 to 75% of the LME nickel price, and the smelter exacts sort of a heavy cost to the miner. Our product will be much more akin to ferronickel. Ferronickel is a product that's produced by several major companies, Anglo American, South32, Vale. That product tends to yield close to 100% of the LME nickel price. And so, based on market testing we've done with Japanese and Chinese stainless steel producers, it has confirmed that our product can bypass smelting and achieve payables much higher than Cliffs had assumed in the previous PEA, around 75%. This shows the different flow sheets that are in use today at the bottom of the screen to produce nickel sulfate. So nickel sulfate is the chemical that goes into electric vehicle batteries. So depending on whether you're dealing with laterite ore or sulfide ore, these tend to be very complicated 5-stage processes to produce sulfate. The testing that we just put out a news release on last week with Sherritt demonstrates we have the potential to produce nickel sulfate in a 3-stage process. So this is a fundamental breakthrough for the project. Shows we've got flexibility to produce for the EV market and can arguably do it in a way that could be lower cost than the other ore types that are typically used as feed. Our focus for the rest of this year is to wrap all of the optimizations that we've arrived to over the last several years and put that in the context of an updated economic study. The 2013 PEA that Cliffs did, we wear it as a millstone. It suggests the project needs a nickel price in excess of $9 a pound to be feasible. Based on the areas that we've optimized between step-out drilling, improved metallurgy, improved understanding of marketability and a lower exchange rate, we're now quite confident that this project will work at a much lower nickel price. And putting out that updated PEA later this year, I think, will be the market's first opportunity to recognize that not only is this a large nickel project, but at this scale of project, we're not aware of other nickel projects that work at a lower price than this one will, and that's what the PEA should demonstrate. Our capital structure is fairly straightforward. We've got 155 million shares outstanding. The company's been public since 1996. We've never done a rollback or consolidation of stock. Currently, there are no warrants outstanding on the stock, so when we do private placements, we do not issue warrants. Management owns 18.5% of the company, and we've got 5 family office and high net worth individuals who collectively hold another 35%. We currently have cash of around $1.75 million. We're fully funded to deliver a PEA and do the rest of our planned activities for 2020. So in summary, a very large nickel deposit in a company with a market cap in the range of $20 to $25 million, chiefly because the market has yet to understand the economic fundamental improvements that we've made to the project, which we'll be able to deliver and make clear to the market with the delivery of an updated PEA later in 2020. Thanks for your attention.